Today's market call is presented by CME Group, where risk meets opportunity, and FactSet, financial data and analytics powered by tomorrow. There are special days, and there are special days, and today happens to be one of them. Of course, it is 11 a.m. on the East Coast on this Tuesday, September 16th. The handsome man with the newly coiffed hair. Did you get a haircut or no?
I don't know. It's just running wild at this point.
Well, you are running wild.
Yeah.
That's, of course, Danny Moses.
What's with the black T-shirt underneath the dress shirt? Is that a new thing also?
No, it's not. Well, since you asked,
All right,
I mean, Amanda's probably pissed off.
All right.
Hold on. I don't even know. See that? I got a little stone pony
there you go.
thing going on.
All right.
But I didn't want to wear a black T-shirt because then I look like, one of the cool hipsters or whatever people call. But Danny's here, which is always great. And today, Danny Moses, we had an S&P 500 that made a new all-time high. Why? Because it's open, 66.26 and change. We've traded a little bit lower since. Again, I'm not making a big deal out of anything because making a big deal of anything over the last couple of years has been a fool's errand. But here we are. So let's just sort of take your temperature as to, what you feel has been going on and where we are in this sort of market cycle, to the extent that it is even in a cycle.
Valuation be damned. That's fine. More buyers than sellers, more
True.
ETFs than stocks, a lot of M&A going on. AI still seems to be the driver. You have broadened out a little bit, actually, in terms of, market breadth. So it's not terrible. I was out at the Hood Summit in Las Vegas last week, with thousands of retail investors. And I can tell you to a person, obviously, they were all pretty bullish out there. Yeah. And so I get the sense that that's just bigger now than fundamentals. And I would caution a little bit ahead of this Fed meeting that it should be a sell on the news, but things have not gone the way that you would think from a behavioral finance perspective. But we know a quarter cut is coming. We got a dot plot, and we'll see what the outlook's going to be. But I don't see how it's any more than 3 cuts coming out of that, during the course of the year. So there's 2 more meetings after tomorrow. So I would be a little bit cautious here, Guy.
Yeah, well, let's talk about that. It's the CME Fed Watch tool. We can leave that up. It was, and we've talked about this, but August of last year, when the S&P was probably 1,100 points lower, the market was pricing in anywhere from 4 to 6 rate cuts in 2025. Now it's a foregone conclusion that we have 3, which is fine. Yet here we are with the market. So to say, at least through that lens, that the market's pricing in, it's pricing in that and a lot more in terms of, Fed participation. And there are 3 meetings left, I guess, this year. It's this week. It's again in October. I think November, there's a break, and then we have one in December. I think it's this foregone conclusion that we'll get 3. I think any more than that is probably wishful thinking. But, as I just stated, at one point there were 6 priced in. So, you get this market at these levels, and you said valuations be damned. You're right. And we say it all the time that valuations are not a timing indicator, but, whatever you want to look at. And, that Buffett indicator is flashing red north of 210%. This is cyclically adjusted price to earnings. The CAPE ratio is at the second highest reading in its history, and 2 or 3 or 4 standard deviations away from the norm. I don't really understand what the retail investor is all geeked up about, other than this. I think they feel they're nimble enough that if something were to change, they'd be able to get out. And maybe that's the right course of action, Danny.
So what else has happened during that time period? The dollar has debased itself.
Yes.
And you need to take that into account when you're looking at the S&P 500 just from a buying power perspective. So weaker dollar, S&P going up, all things being equal, can offset each other. So you can look at absolute, or you can look at relative performance. What else has happened? It's a certainty that, Powell is gone in May. It'll be more, quote, accommodative Fed. Whether you think that's good or not, I don't know. But the one thing, Guy, also within the last year, what's changed is the belief that inflation would keep going down, and it's not. It's back to the highs of the year.
Yeah.
What you're looking at as far as measurement. And so we sit here today, we're going to get a cut potentially into rising inflation. Again, it's not crazy inflation. We're hovering just under 3% probably, but it's not that 2% number. And so something's going to give here. And I think also, Guy, I think the feeling that tariffs came and went, that's up in the air as far as the legal basis for keeping them, whether you're going to have to refund money, whatever it might be. But the other thing that's happened for certain Guy is even with the tax bill passing, that the government's finances have never really been worse. And I don't see a way that they're going to get better. And I think we've kind of kicked that can down the road as well. So I think we've pushed all this stuff. But what's the overriding thing, Guy? It's 10-year yields. And if 10-year yields have calmed down to a level of around 4 to 4.05%, we'll see. People feel like that's a level that we can. The last thing I'll say, Guy, is, and I talked about this last week at this Robinhood conference, is the feeling that, credit spreads are tight, which they are relative treasuries. Treasuries have now actually come in. So we had something was going to happen. Either treasuries are going to rally and yields will come in, or investors would back out here. But when you look at the MOVE index and stuff, the things have calmed down there as well. But I will say this again, I think corporate credit is a safer place at the yields they have to put their money than 10-year yields in the U.S. government. So
I saw Scott Bessent on this morning, Treasury Secretary Bessent, with the Squawk Box crew, and he was talking about the yield curve, and he was talking about, Becky said to him, you do understand, maybe she didn't say it that way, but effectively saying, the Fed controls the front end of the yield curve, and remember this time last year, the Fed cut by 50 basis points, and the bond market actually sold off on the back of that. And his retort was, it was a much different environment a year or so ago. And maybe that's right. And, maybe they're going to stick this landing. But you mentioned a lot of things that are important. You continue to mention the weakness of the U.S. dollar. And I got to tell you something. I don't necessarily know what to make of it. A lot of equity bulls will say a weaker dollar is supportive of valuations and supportive of, obviously, multinationals that sell a lot of their goods overseas. So that's encouraging. But at a certain point, this weaker dollar, and it's been now dramatic over the last year or so, it's going to be a net negative, I think. And, I think when you have a $37 trillion debt sitting on top of a, $29 trillion economy, you're not necessarily going to grow your way out of that problem. You're going to basically inflate or devalue your currency away from that. And that's the policy. And that's a dangerous game, Danny Moses, probably something you know better than anybody.
I fully expect, speaking of Bessent and whoever is obviously going to be at the Fed helm, quantitative easing to come back. And so when you think about the Fed balance sheet moving from 9 trillion, down to kind of 6.6 trillion, what's another 2 trillion going up, between friends? What if it goes to 8.5 trillion? If that's the signal that they need to keep long-term yields, I'm not saying that's the right thing to do. I'm saying that might be the only choice that they have to keep talking down, this market. And so, listen, that's a big deal. This dollar moving, and what is coming in space? It's gold and Bitcoin. That overlaid those. They're flipped, right, in terms of where are people going. And so the dollar's losing its reserve status slowly. We'll see what might happen. But the irony here, Guy, is if the dollar gets its groove back, it's probably going to come at the expense of the S&P 500 at some point. So something's going to give here. And every crisis is born out of FX, right? It always has been. It probably always will be, because it's the one thing that's levered across the world. We talk about Japan from time to time. You look at, sterling over in the UK. You look at these things. A lot of these things are at really interesting levels, and normally that's a signal of something that's going to come, at least from a volatility perspective, Guy.
We got a lot of questions for you that we will address, but look, this is a dollar chart, and if you want to put it back up and go longer term, I mean, it really doesn't matter what you're looking at. I think the euro right now is 118. I'm convinced it's probably headed to 125, but we're at levels that we haven't seen in a couple of years, and it feels as though, to me at least, you're looking at a potential retest of those levels that we saw, and you can draw the horizontal line across. You can see those bottoms as clear as day. That's where it feels like this thing is going. And then you mentioned gold. Well, let's take a look at gold, because finally, Danny, the gold miners have been participating in a meaningful way. And this has been a long time coming, but the GDX is at an all-time high. Even frickin' Newmont Mining, which was left on the side of the road for a long time, is finally catching a bid. And, about time, I guess, is what I'd like to say there. But my question to you is, I'm convinced, and I don't know if I'm right, but there's clear sailing for the commodity. I guess my question to you is, does that mean these mining stocks can continue on the trajectory that they've been on?
It's interesting. So we talked about this, I think you and I on Market Call earlier this year. We specifically highlighted Newmont Mining. It's the only gold miner in the S&P 500. And we talked about how portfolio managers have to operate. The overweight sectors, underweight sectors, a lot of them just either have a market weight in gold or just ignore it completely. But this is the only way that they can really play it and express it. So I don't know where metals and mining are at the current moment. They're a small percentage of the S&P 500, but these are the things you start to see, and they self-fulfill, right? So if Newmont starts to go up and you don't own it as a long-only manager at Fidelity, this is the one you can own if it's in your benchmark. And so I think that explains Newmont. I'm sure it's not even that much different than the overall mining index. But yeah, I think that we're starting to see these things start to work, because with the tailwinds, I think the longer that gold stays at these levels, it shows that it's not going to retreat, the more valuable potentially the earnings that can come out and cash flows from these gold mining companies. So I think it's a great place to be.
I think that's right. I think that's exactly right. And the point that I've made is so many market participants historically have been smoked trying to be long gold miners as gold is rallied, only to have then gold falter and the mining stocks basically take it on the chin in a meaningful way. And I think finally there's been this realization that, wait a second, gold's really not giving anything back, and we're going to have to play a little bit of catch up here in the mining sector. And that's what's happened. So it does make sense to me, but even with the move, and I think you would agree with this, I still think they're undervalued and underowned to the extent that that's a thing. So I think the chase is going to be on into the end of the year. We'll see. By the way, silver's been participating in a meaningful way. That's something that I know you've talked about. And if you look at, for example, a Pan American Silver, which is down today, but look at the type of move that stock has had. And we're getting back to levels that we probably saw 4 or so years ago, and probably approaching all-time highs that we saw probably 14 or 15 years ago. So this trade to me is not going anywhere anytime soon. With that said, something that you talked about the summer of last year, along with Vinny and Porter, is Alibaba. And we have a question about Alibaba. It's from the Situation Room. So if you want to throw that up and we'll address it. But, what's your view on Baba here? What do you think? And Alibaba's had an extraordinary move since the beginning of the year. It's probably up 80-something%-ish or 75%-ish. I still think there's room to the upside. I know this was the move that you guys were talking about last year. What are your thoughts on Alibaba?
And that's a great looking chart. If Carter were here with us, I think he would say stay long, be long. And listen, it was obviously being ignored with all the other stocks in China at the kind of the start of the year. A lot of concerns politically, as well as on their core business. But look what they've done. They've kind of reintroduced themselves to the world, and the stock actually is still cheap at these prices. Could it come back down? Sure. It's probably a buy on weakness at this point. But Baidu, if you look at that chart as well, a couple of these have had kind of their AI moments here coming out, and on a relative basis to the U.S. names, they just became really cheap. That Baidu, by the way, you go to, there you go, on that chart. But look at that thing. And so they're just being, I always call it like beauty pageant, right? You come back out, everyone was ignoring them, and you look and say, wow, hold on a second. These stocks are cheap. Well, they're cheap for a reason, because there's a discount to owning them, obviously. But again, I think these things still have room. And so I think the hype will continue there. And I think if something happens in the U.S. markets, and I think you could see money move there as well. So I think I don't want to speak for Port and Vinny, but they're probably not as long as they were, but they're still long. So.
Yeah, well, I mean, and that's just portfolio management, but I'm sure they are. And again, you guys had this thing cold last year, so I want to give kudos to you. And we've mentioned that on Fast Money a number of times. The one that I've looked at is this sort of K-Web, and we have pointed out that that's the internet, the China internet ETF. I think it's Crane or something. But point here is we finally got through those prior highs of about 39 or so, and here we are. And you look at this longer term, and this to me is, if Carter were here, is a classic bearish to bullish reversal that's been formulating or percolating since late 2021 or so, and now this thing is starting to turn. So there's a real, to me, I think despite the fact that these have all had huge moves, there's more to go here, and I think it's divorced itself from the U.S. equity market for better or for worse. So I say stay tuned on that front for sure. This is from John Crenshaw to you and to me. Palantir, Robinhood, Tesla, key moment, and he's saying to load some puts with a low VIX. These stocks have become casinos. Listen, you were just at the Robinhood conference. I think, and I have said this on Fast Money, I've said it here, they have operated extraordinarily well. I think their recent inclusion, I guess, into the S&P, maybe that's time for a pause here, and valuation is a concern. It's also made itself a $100 billion company. But the one that I want to sort of take a look at and is Palantir, which, again, at 170, it's not like it's falling off a cliff, but it really hasn't done a lot since early August. And, this is one that I don't want to say it's going to drive the broader market, but this has been a poster child for valuations be damned, full speed ahead type of thing, Danny Moses.
Let me address the idea of using puts in a low vol environment. That I agree with. You can only lose what you put into the puts versus shorting these stocks. And a lot of these things trade together, the same ETFs, so they're kind of grouped together. And so you get lured into this, kind of chart here. And I think a lot of charts look like that. I think NVIDIA is similar, had the similar drop, similar recovery if you were to put the two kind of on top of each other. So let's just throw that one in. Yeah, pretty much the same, pretty much the same thing. So kind of guy, I agree with them all together. They all are different when you talk about a Robinhood, a Palantir, a Tesla, and NVIDIA, all different on the margin. Robinhood is interesting because they are really starting to take market share, I think, from the incumbents. And now with private banking being offered and event contracts, which I could talk about forever. But one thing I did see, Guy, which feels like the market is, I saw a guy in Las Vegas sitting next to Vinny and myself, double down on a hard 12. Okay, not a soft, a hard 12. Okay, soft 12 would be aces. You would split those, obviously. Hard 12 against the dealer's 5. I looked at him. So what are you doing? He goes, I'm just feeling it. And I would tell you that's what this market is to certain buyers here. I'm just feeling it.
How did it? I'm just out of curiosity.
How did it go for him? How did it go for him? He was sitting at third base. He obviously drew the 10. What did the dealer have? 15. What was the next card, Guy? 6. What was I sitting with? 20. You could put that in a brochure and send it out. And the dealer's name was Jimmy Fingers. You can't even make that up. That's his real name. Jimmy Fingers was anyway.
That's when you get up and walk away. That's when you get up and walk away.
Exactly. But anyway, please, next question.
Because that's a sign. That is a sign.
Yeah, I did get up and walk away, obviously.
As you should have. That's the correct thing to do. But it speaks to, that's anecdotal, obviously, but people feel bulletproof in almost every aspect right now. And I don't think the market is that far away from it. I think people feel bulletproof in this market because, quite frankly, they've been rewarded to feel bulletproof in a number of different things. And I think if April taught us anything, or at least taught the market participants anything, is if a sell-off does come, it's going to be short-lived, and we have to take advantage of it, not to fear it. And I guess it makes sense. But I'll also say this, and I didn't know this, and I apologize. I'm supposed to know these things, but I've been away, so I'll give myself a pass. But you have a pretty big options expiry on Friday. Even Jacob knew that, and I'm not casting aspersions, but here we are. So thoughts on that with the VIX north of 16?
Yeah, it's this is the event, right? This is the Fed. This is the biggest meeting so far during this investment cycle that we've seen. So there's a reason for it. And so what happens after that? What we've normally seen is protection goes away potentially. Let's say the market kind of flat lines from here, and I don't know what it's pricing in, all the vol and the calls and puts right now on the S&P 500, where it's going to quote pin, but inevitably you end up on Monday following with wasted money and less put protection. So I've seen instances where on the Monday following large expirations, you tend to be a little bit exposed. So something to think about as we go into the close on Friday. And you and I, before we got on, we were honoring Robert Redford, and I thought you had a great point when it was, barefoot in the park. It's kind of like the theme here in the markets to a degree. I think you wanted to kind of talk about that. It doesn't feel, quote, natural. It feels, people running around barefoot in Central Park.
Well, that's the first of all, Robert Redford is just absolute genius. I mean, we can wax poetic about the movies that we all love. I mean, Butch Cassidy and the Sundance Kid, The Sting, Barefoot in the Park with Jane Fonda. Say what you want about Jane Fonda's politics. I mean, she was happening back in the day, and that was a wonderful movie. And if you want to go back and take a look at what that movie was about, that's about a woman that lived life, without a care in the world, with a husband who was as stiff as a board, who then subsequently decided he's going to sort of embrace some of his wife's idiosyncrasies. And off he went, and he was in barefoot in the park, and he got himself sick, and blah, blah, blah. But I think it's somewhat of a metaphor for what's going on in the market right now.
I knew I could get you off of the subject here with that, but yeah, sorry to do that too. But yes, it is big loss.
It's all good. We have a question about Broadcom. And again, it's one thing if these companies were, $30, $40 billion companies. This is now a $1.7 trillion company, if you think about it. And think about the move we've had over the last, I don't know, since April. I mean, the company has more than doubled since the lows. Again, it doesn't make a lot of sense to me in terms of what people are looking for. And, this is from Clubber Lang, which I know you're a big fan of. RSIs and MACDs are off the chart. We don't have it here, but my sense is that's exactly right. And, when you have a company of this size that sees moves of that magnitude, it's got to be concerning. By the way, we saw the same thing with Oracle. We saw the same thing with Broadcom last December. I mean, it just repeats itself over and over again, Danny.
I'm the wrong guy to probably talk, but again, very similar to some of the other charts. And what happened, this is now, what are they calling? It's no longer the Mag 7, it's the Ninja 9. I don't know.
I don't know. That's a Dan Nathan
thing. So I think it's in there now. But again, here you have a market cap that if you're a fund manager, you can't afford not to own, again, in the ETFs and all the stuff. But inevitably, secular trade turns to cyclical. And when that happens, I don't know. But rest assured, when the comps become harder at some point, even if the company's still making money, it will no longer have these multiples. And so I feel like we are projecting a lot into the future without discounting back at the appropriate rate, which is how you're supposed to do equity valuations in time. But I'm not going to stand in front of that thing. I'm certainly not buying it here, but I'm not, So.
Now, look, I mean, I think it's to have its day of reckoning at some point. And but just full disclosure, I mean, prior to last December, Broadcom was a name that we talked about. We waxed poetic about, saying, listen, if you want to belong a company on valuation, Broadcom is the way to play this thing. And then it obviously was correct, but a 35-40% move in December, I think it was December 18th or something of last year. I mean, that's historic, but that's become sort of the norm for, again, not insignificant companies. It's amazing to me that a company like Oracle can have a move like it had, given the size of the company that it is. To me, that's not a sign of a healthy market. Anyway, that's my rant. Let's take a look at some energy stocks. We have a question. I think this is is it from Wavy McFly? Yes, the great Wavy McFly, who's here every day. Danny's your favorite energy name, slowly making 52-week highs, and a lot of these things. I will say, just let me talk for a second. Valero has been a name that we have talked about over and over again, and one of the reasons we've talked about it is because the crack spreads are favorable. And what does that mean? It means they buy crude oil, then they refine it into different products. So when you can buy crude cheap and sell products dear, that's extraordinarily important. By the way, it works for Marathon Petroleum as well. So thoughts on this space, Danny?
Yeah, some are levered to oil, some are levered to gas, some are levered to gasoline. The names that I want to focus on within energy are the ones that you're going to need to power this great AI trade, because you cannot disassociate the power needs, whether it's uranium, which we're going to talk about here, or natural gas, whatever's going to power these grids and utilities. And I like Range Resources, RRC here. And if you bring that one up, that one hasn't had the move that all these things have had. It trades more in line with natural gas, but again, from a long-term demand perspective, this is something I feel good about owning. It has a small dividend. Some of these things do, and these are names that Porter and Vinny have talked about as well. So I'm long the big ones in terms of oil. ExxonMobil, obviously, I own here. Chart's okay, hasn't been great, but I do think these names will be, again, if money comes out of the top 9 names, where is it going to go? I think it's names like this that fundamentals still matter. And this is even with oil and nat gas taking the hit that it has. Again, kind of, we talked about gold and gold miners going up and going up more because gold seems to hold its price. These things are holding steady in the face of the underlying commodities actually moving lower. But again, long-term secular trade, nat gas and uranium. And if we could bring up spot uranium, which you can use it by SRUUF, which, sorry, guy, to take the take the wheel here. But you talk about another sector that you're going to have that is a generational trade. I mean, look at that chart and go out farther. we're going to I think we go towards the $25 level again here. And so again, you want to believe in AI. If you're listening to this, then tell me what is going to power it, because you cannot meet those estimates without it. And so this is a 20-year trade here, guy. This is not
I
a
agree with that.
so
And
anyway,
I'm
sorry.
glad you brought that up because we talked about it on Fast Money, and this is a secular shift of what's going on now. The problem, not that there's a problem, but over the last couple of years, when the media starts talking about uranium the way they are now, that's typically been the place to sort of exit and wait for a different entry point. And we might be on the same thing here. But now you mentioned the Sprott Physical Uranium Trust. Throw up URA, which is basically, the global X uranium ETF, to the extent that that's interesting to anybody. But it's had a big move recently. But this is potentially, and you go back all the way to 2015 in this sucker. You want to talk, and you got to go longer term, and you'll see what I'm looking at. You're talking about a potential sort of bearish to bullish reversal in a pretty meaningful way here. So what I'm going to say is you don't have to pile into it at 44. I think you get a better entry point, but this has to be on your radar screen without question, because there's something going on here in uranium.
Can I comment on that, guy? Because it's not
absolutely.
It's not a wonderfully constructed ETF.
No,
the top
it's not.
holding is CCJ, so it's going to look the same. The fourth largest holding is SRUUF, and I just want to point out that there's very few miners control the majority, obviously, of what we see on the market. The stuff obviously is not coming out of Russia. They obviously have a lot of it as well, but the miners are here and there. They can cut back production. I think the price of uranium's hanging in the high 70s. I think we could see it to move to 100. So I'd just rather play the spot than worry about ETFs or specific mining companies. That's just me.
This is from Oliver Burns, and this is a good one. And I'm reading, so I apologize. But if Amanda wants to throw it up, I can read from the screen. What type of exogenous event would have to occur for investor sentiment to carry less weight and prices revert back to what fundamentals reflect? Not Burns, Bins, so I apologize. I don't know the answer to that, because there have been all kinds of exogenous events over the last couple of years that historically would have moved the market that seemingly have little to no impact whatsoever. So, I thought in April when we saw that bond market blow up, that could have been it. And I got to tell you something, there was a 6 to 10 hour period of time where the bond market was melting down, but that was short-lived as well. Any thoughts on that, Danny, at all?
I mean, we've had a couple of things that have happened in the last few weeks that I was shocked the market held. Was China effectively telling the world they have AI chips and they're much cheaper, and they're going to proliferate. And I was like, okay, so there's competition coming for NVIDIA. One of the things has been this 70% gross margin type thing that we've talked about. When there's a secular trade going on, you can have that, but over time a product becomes commoditized. So that was, to me, an exogenous event that kind of went by the wayside. That was one thing. The other would have been something coming out of a trade policy, another tariff announcement, which really has been more bark than bite. I think another one would just be 10-year yields. So what's exogenous event would have been something happen where 10-year yields, start to move higher and a bond fund gets carried out, or we hear about, some commodity or trade where someone gets carried out, or this. So it's always leverage that creates an exogenous event, and you never know where that leverage sits until you have major moves in certain asset classes. So we'll see, but there's a lot, guy, that I think could go wrong versus a lot from here that can go right, that could continue this going higher. So before we
5,000, you were one of the first people to talk about the possibility of stagflation. It was about 14 months ago that Jerome Powell, in response to a question, said he saw neither the stag nor the inflation, thinking that he was clever. And, as it turns out, well, we have the stag. I mean, clearly, because if you look at data, things have absolutely been slowing down. And the inflation has been there for a while, and it does not seem to sort of, acquiesce to some of the historical forces that would have made it acquiesce. The only thing left is sort of the job market, and the unemployment rate, although not at a bad level, has been ticking higher. And I think that's a foregone conclusion as well. So you've talked about the dangers of stagflation because there's no arrow in anybody's quiver that can fight that. So real thoughts on that real quick before we leave.
Yeah. Well, here's the irony. And, the stock market is obviously not the economy. Economy is not the stock market. If the stock market were to start dropping and people wanted a reason for it, it might be, because there's stagflation. the irony is that AI is making companies more efficient, potentially at the expense of the overall economy in terms of jobs and so forth going forward. And so I think we're just in this weird period, Guy, where it's earnings projections first and top names carrying the weight of the S&P, and worry about the rest later. And they also thought would be, well, I don't care because we have a huge rate cycle of rate cuts coming. So it's not going to matter. And you know what? It doesn't matter right now. So those things only tend to matter when you get your report card and you're like, what did I get wrong on the test? Because, and so you start to plug in, oh, it was stagflation. That was obvious. Oh, it was a competitor to NVIDIA's chip coming out at 10% of the cost. That was obvious. So again, no one cares when the market's going high. It's always looking for answers when the market's down.
Agreed. Nobody cares when everybody's cheering right now. Nobody wants to hear it, but you've been the voice of reason. You have been doing an extraordinary job with the On the Tape podcast. I think you're sitting down with a really interesting person today.
Keith McCullough, Hedgeye, has been doing it since he left Wall Street effectively in 2008. Built a great firm over there. Always great to get his macro thoughts, and obviously has a large cohort of analysts on there covering several hundred names. So yeah, looking forward to have him on. And then I got Meredith Whitney coming on next week, and she's been really on top of what's happening with the U.S. consumer, specifically, at the lower end, and then a lot of good guests coming up from there. So looking forward.
Yes, you do. You've done it. I love it. It's great. I'm thrilled to be a very small part of that, but you've taken the reins and you've sort of run with it. You're a jockey on a thoroughbred, if I may. Is that accurate?
I would be the heaviest jockey to ever win any type of race, but I appreciate that, Guy. Thank you.
Well, neither here nor there. I have to go. That's the great Danny Moses. Check out the On the Tape podcast. Keith McCullough is entertaining and very, very bright, and this is somebody where rigor is an everyday word. So enjoy that conversation. Meredith Whitney next week. I've enjoyed this, Danny Moses. We'll be back tomorrow on the Market Call. I think Dan Nathan is back from his exodus, so we'll see you then, folks.